Greetings, my name is Benjamin Gedan. I'm the Deputy Director of the Latin American Program at the Woodrow Wilson International Center for Scholars. I'd like to welcome to today's conversation Ben Ramsey. He leads Latin America economic research at JP Morgan, and also Alejo Czerwonko. He's the Chief Investment Officer for Emerging Market Americas at UBS. Alejo, Ben, thank you for joining me.
You mentioned.
Great to be here.
Alejo, we will start with you. The pandemic, of course, has not ended in Latin America, where fewer than 1/4 of the population is fully vaccinated, and the Delta variant threatens to accelerate the spread of COVID-19. That all being said, it strikes me that a conversation about the region's rising debt burden should not continue to be put off. That is why both of you are here today. Largest debt burdens in the emerging world, worsened by an explosion in public spending throughout the pandemic that governments largely finance through private capital markets. Interest rates for now remain low, but a change in policy stance by the Fed and other major central banks, together with the recent series of credit rating downgrades, could increase borrowing costs for the region, even as health and economic troubles and loud public demands put pressure on governments to continue high levels of spending. In the first 4 months of this year, we saw 5 credit rating downgrades in the region. There were no upgrades. Alejo, how worried should we be about Latin America's post-pandemic debt hangover?
Look, Ben, we think this is a severe problem indeed. Latin America was facing fiscal challenges pre-pandemic, and these were seriously exacerbated by the disease. Social demands for public goods and services were high in the years prior to COVID, and they are now even higher. All of this puts serious pressure on credit ratings, on borrowing costs in the region, which might not seem like a big deal today when liquidity globally is quite abundant, financing costs are low. So far this year, for instance, emerging markets were able to place bonds in international capital markets in the amount of $500 billion, the most of any start of the year in the last decade. But it does remain a source of vulnerability if and when the liquidity tide turns. It is, in my view, the Achilles heel of the Latin America macroeconomic outlook.
Maybe, Benjamin, I can just compliment with Alejo's comments on the debt stocks and the risks ahead. And also looking backwards, I think it's important to keep in mind that our region hasn't been growing. Really hasn't been growing since the decline of the commodity super cycle at the end of 2014. So, the indicator of debt to GDP is not the end all and be all indicator. But certainly it's one that the markets pay attention to, that rating agencies pay very much attention to. And that indicator is going to worsen if the denominator, GDP, is not growing. So if you don't have the ability to grow out of that debt burden which you're incurring. And this was really a problem for Latin America prior to the pandemic, really adjusting from that fall in the global commodity super cycle. We didn't think that the region would have as much space as it did to take on debt. I think it was certainly helped by the global liquidity conditions that we've mentioned. But we are really concerned about not just the debt that the region's incurred, but its ability to grow with the scarring that we're seeing to labor markets, concerns about private investment going forward, as we have basically some concerns about whether the macro framework which has prevailed in the region will be resilient here.
Thanks, Ben. No, important point. And I don't think anyone is particularly optimistic that the factors that predated the pandemic that had kept growth relatively slow in Latin America have gone away. In fact, I think you've pointed to a lot of reasons to believe it may have even been worse and that the recovery will really be slow, making it more difficult to service all of these new debts. And I want to turn to something going on in Colombia recently. As you know, the country became a so-called fallen angel. It lost its investment grade rating in May of this year, 2021. By my count, all that's left in the serious economies in the region with investment grade are Chile, Mexico, Peru, and Uruguay. My question is, why is investment grade important in the first place? Do you expect more of these fallen angels in Latin America? And does the presence of investment grade countries improve the investment climate throughout the region? So even for countries that don't have that designation, and what would it mean for investors considering investments in Latin America if the region ended up fully without any investment grade economies? Alejo, you'll weigh in as well on the subject, but you first, Ben.
Well, I don't think investment grade is certainly an important goal that the countries try to attain. And I think the most important reason why they try to attain investment grade is really to just broaden the universe of institutional investors that can invest in their securities, both public debt securities to finance these deficits and the fiscal impulse that has been needed, to basically to surf through this pandemic, but also institutional investors that invest in corporate bond markets, in equity markets. So the broader the universe of types of funds that have mandates to invest with, there are plenty of funds with only investment grade mandates. It just means you have that much more of a universe of possible capital to come into your country. And that, aside from sort of the seal of approval that you are sort of running your macroeconomic policies in a prudent way, it provides this important, what we would call a market technical, which just means you can have more inflows into your markets. And at the end of the day, more demand for those securities, be it from the private sector or from the government, will tend to lower the interest rates in terms of the debt securities that either corporates or governments are issuing, or that should have a follow-on effect in terms of the type of inflows that can go into equity markets.
So Alejo, Ben points to limits on certain funds that can't invest in a country that doesn't have investment grade. I'm interested also in sort of the broader halo effect, the symbolism of investment grade, both for those that hold it in a region that is home to several countries that have achieved investment grade. What do you think, Alejo? Am I exaggerating the kind of broader feedbacks that you get in a region that can point to a few economies that maintain that housekeeping seal of approval?
Absolutely, Ben. I don't think you're exaggerating. I think the investment grade moniker is quite valuable for emerging markets and Latin America in particular. It is a clear signal of macroeconomic stability. As Benjamin pointed out, it's a stamp of approval that leads investors to ask fewer questions before they decide to allocate capital to a particular country. It allows different countries to access broader investor pools. When you think about global institutional investors, such as global pension funds, global insurance companies, many of these are limited to invest only in investment grade securities. They have high yield as off limits. In addition, the topic of financing costs is quite relevant when it comes to investment grade. When you take the last 10 years, emerging market countries right below investment grade paid 1 percentage point above those right above investment grade when it comes to dollar, euro, financing costs. So this can be meaningful over time, and this gap in financing costs increases in times of stress. So by and large, I think it's a very important concept, something that it is also quite difficult to attain and relatively easier to lose. So it's usually historically what you see is countries can lose investment grade a lot faster than they can regain it. So it's a very valuable concept that helps Latin America in this case in its path towards economic development.
So good ratings here give you, access to more affordable financing, access to a universe of capital you might not otherwise have access to. Then it sounds like a clear case to make that government should be taking the steps they need to take to retain investment grade, to acquire investment grade, or at least to avoid downgrades. And yet, I think you'd agree in the political economy analysis, it's easier said than done. We'll turn again to Colombia, where President Ivan Duque set off massive protests earlier this year when he proposed a series of spending cuts and tax hikes precisely designed to ease concerns about the growing deficit and to prevent this fallen angel status, which ultimately occurred anyway. My question for you is, what went wrong in Colombia, but also what impact might that have on other governments who otherwise would have seen the world the way you and Alejo do and recognize the importance of taking prudent macroeconomic steps with ratings in mind?
Well, I think first of all, what went wrong was really the ability of the politicians in the government to embrace its own narrative of what the finance minister was trying to do and to properly sell it. Now, you mentioned that it was an austerity package of spending cuts and tax hikes. Well, actually, they were looking to have a carrot and a carrot today and a stick later. And the carrot was increasing spending, social transfers through this year and next, and eventually having tax hikes that would be coming into play in 2022, 2023. And yes, the original plan was going to increase the level of personal income tax that was paid by the middle class. And that was just politically unsellable, whether it was going to have an impact today or in 2 years. But if the narrative had been, I think, better embraced and better sold, it might have had a chance, at least not to spark the street protest. Maybe we would have had sort of the normal Colombian ritual of watering down a reform and then going back 2 years later for the reform. At the end of the day, Colombia has been able to come back to the table. It has been able to, it's putting into Congress right now another version of this reform. But I think what the rating agencies saw was a country that was already seeing fiscal deterioration, drift, higher debt burden, even before the pandemic. It was one where, in Colombia's case, they did take the decision to increase spending in 2021 rather than sort of have the deficit start to decline. I think that gave a little bit of nervousness. And then when this reform, which was a structural one that would have been, I think, put Colombia on the right track, was politically completely unfeasible. I think the rating agencies took the notion that it's going to be much harder going forward to come back to the table with that type of reform again. I think the lesson of the failure of this reform in terms of the political lesson within Colombia means it's going to be much harder to do the incremental heavy lifting that Colombia needs to do. Of course, we have an election cycle and next year, and we need to see how that plays out. But I think, it wasn't always a difficult decision here because Colombia wanted to basically keep growth intact. And the whole idea of having a fiscal impulse at this time in the middle of a pandemic is precisely to make sure that you're protecting firms and household balance sheets such that they will be ready to go once this shock is over and you don't sort of permanently lose that sort of, let's call it stock of capital, whether it be human capital, whether it be physical capital, ready to sort of have your potential growth be intact once you get through the other side of the crisis.
So Alejo, Ben has laid out some of the political challenges in the Colombian context for this reform. I don't see a huge appetite for austerity really anywhere in the region right now. And I think, one of the disappointing elements of what happened in Colombia was a sense that if they can't pull it off, who can? And it's not just that there are elections coming up throughout the region. I mean, I think if you look around, yes, we've seen, the leftist president of Mexico, Andrés Manuel López Obrador, AMLO, who was surprisingly hawkish on spending. But in general, you've got the return of the left to Peru and fears that it could jeopardize what had been in Peru, a traditionally conservative macroeconomic policy framework, despite the appointment of a respected economist, Pedro Franque, as President Pedro Castillo's finance minister. There are concerns even in Chile, of all places, where there's a constitutional rewrite going on right now. And there are fears that it could impose a lot of spending burdens on the government as it expands the obligatory social welfare programs that the government should provide. I guess, broadly speaking, my question is, are there any admirers left of the Washington Consensus in Latin America? Is there anyone, in the region in positions of influence who can stand up and say that we can't go on like this forever?
I think, Benjamin, the short answer to your question is no. It's very difficult to find a large Latin American economy or a large global economy, for that matter, that is taking fiscal consolidation and fiscal prudence seriously these days. This is something that I want to emphasize. It's not only present in Latin America, it's happening in the developed world, quite interestingly, in the United States and beyond. So from a fiscal perspective, I think the world is feeling a lot more relaxed when it comes to consolidation. I think developed markets with global reserve currencies can afford this for some time, but emerging markets and regions like Latin America that have a poor track record in this area cannot, right? So I do hope that the tide at some point turns. It's interesting, we've been talking about fiscal policy so far in this conversation. There's a stark contrast with respect to monetary policy in Latin America. We're seeing quite a bit of orthodoxy these days in a context in which inflation pressures have been going up in Latin America and globally. Latin American central banks have been sticking to their hawkish credentials and hiking interest rates almost across the board. So let's see how this gap in orthodoxy plays out over coming months. I think the likelihood that we see more fiscal responsibility in the rest of the region is low at the moment.
Ben, I'll give you the last word. I mean, it seems alarming to me. I think Alejo makes a strong case that outside the central banking world, the deficits are not being taken seriously. Then again, you said, look, this is the time you spend when you want to preserve, you've said human capital, you want to avoid bankruptcies in businesses. That would be the kind of scarring that's hard to recover from. I just don't know how long you can continue to justify it in those terms when we don't know exactly when this public health emergency and all its economic consequences might end.
Yeah, it's a tough call, and I don't think we sort of have a uniform examples across the region. I mean, Brazil by far spent the most in 2020, and as much as they would have perhaps liked to, from the executive branch, continue that type of spending this year, their own fiscal institutionality and market discipline is basically forced them to toe the line. I mean, they're still trying to push the envelope, and we're still having sort of a push and pull with markets, and we'll have to see where that goes again as we head into yet another election cycle in that case. And then if we look at Chile as another example, there we've seen massive fiscal stimulus complemented by basically early disbursements of the private pension funds, which means basically there's just a huge amount of fuel for consumers right now, arguably more than what was needed in the Chilean case, but from a starting point in terms of the sovereign balance sheet, which was just so much stronger, that there is that room, although the Chileans seem to be trying to lean into that room very quickly. And I think if we're thinking about sort of the standard bearers for, let's call it the Washington consensus in the region, or let's call it orthodox macroeconomic policies, it's been Chile. So I kind of do feel like we have to see how far the pendulum may keep swinging in the Chilean case as they're going through a very important political transition, both with the elections, but perhaps more importantly with the constitutional rewrite. And I think Chile may be sort of setting the standard for, as we drift towards larger state, and whether or not we can find ways that where governments can finance these larger deficits without ultimately having this tension that Alejo mentioned in terms of basically fiscal dominance, basically the incompatibility at the end of the day with a structurally loose fiscal policy and what's an attempt to be a strict monetary policy. I think this is what we're, this tension is what we're going to see play out. Not, the beginnings of it this year, but I think this is what we'll need to be watching over the years to come.
And as Alejo also references, unfortunately, in Latin America, this kind of borrowing and debt accumulation often does not end well. Alejo Czerwonko, Ben Ramsey, thank you so much for joining us. It's been great.
Thank you.
Thanks for having us.